Welcome to the What to Watch video update. This is a video that I do once a week where I pick out the charts that are really talking to us right now. Some of these charts are more short term. There's even some intraday charts that I show all the way out to some weekly charts. So we get a short term perspective as well as a long term perspective. And then I take all those charts, I list all those things that are positive, I list the things that are negative, and then this gives us a foundation of what we're going to watch over the upcoming week, and then see how things play out from here. The title for this week is the S&P 500 rotating into a new climate? We could be seeing a shift. You could almost call this climate change if you wanted to. And this is being prepared for Monday, July 15th. The first thing I want to talk about is the program that I have. It's called the SPX Investing Program. Right now, it's for free. You can go to it. There's some additional videos there that I don't share on YouTube or Rumble. I'll be locking things down in August. And then there are some additional courses and videos and things like that that I will be rolling out. It's $97 a month once it gets up and going. Right now, everything is for free. And for a lot of people, they're finding this a really beneficial program with a really high success rate and some good, fairly conservative type positions that we put on and seeing some good returns at the same time. And I'll be posting more videos about that going forward from here. If you want to learn more about the program, there's a link in the description below this video. There's also a link that will take you to the website. Feel free to check that out. If you want to email me and talk to me about these things, ask some questions, maybe set up a time to talk back and forth, we can certainly do that. I also post a number of different videos. What you're seeing right now is the What to Watch video that has developed into a weekly video. I have other weekly videos that I put out, like a weekly video, an intermarket analysis video, a deep dive video, and some supplemental videos. There are a few of those on the YouTube and Rumble channels. Going forward, though, any supplemental videos will just be on the SPX Investing website. Every video that I do feeds into the middle video, which is the daily video. After decades of doing this, I have found the best approach for really analyzing what's going on, takes more effort, takes more time, is looking at the daily charts. We can see things starting to shift. We can start to see things happen before they actually happen, and then we can take advantage of those things, whether they're positive or negative. So all of the videos that I do pretty much flow into the daily video. All the other videos are outside of that. Okay, let's go through and look at the positive things for right now. We look at sentiment, and because we're above 50 and we're going back up, that means that we're looking more positive there. So when we're trailing up and we're not getting extreme, we tend to just roll with this. We go with the sentiment as it's getting more positive. Now, what we were seeing up until a few weeks ago is that the S&P was going up and sentiment was actually going down. That's because a number of the indicators that are used to create this index, excuse me, which is put out by CNN Money, we were seeing some negative divergences. It was just a few stocks that were starting to really climb, and that was pushing the indexes up, and it was pushing these other indicators down. And so we were seeing sentiment actually dropping off as the S&P was going up. And that was a little bit of a concern, but we understood what was going on at that time. We could possibly be seeing a shift now. There's this idea that the Fed is going to cut rates in September, and the markets come up with about a 90% chance as of Friday that there will be a 25 basis point cut at the September 18th meeting. And I go over that in the weekly video. We don't know if that's actually going to happen. That's just what the market thinks will happen as of right now. And so that has helped sentiment to improve. We're seeing small caps and mid caps, although we've seen this before and it's faked this out, we're seeing some improvement in those areas. The negative divergences inside of the S&P 500 that were causing us some concern because only a few stocks were driving the indexes higher, both for the S&P and the NASDAQ 100. Well, those big stocks are taking a breather right now, and some of the other stocks are starting to come in and show some improvement. Now, we've only seen a couple of days of this. We want to see more follow through from here. As these things have been improving, we're seeing an improvement in sentiment. Now, when we start to use this as a contrarian indicator, when we're looking at going against the crowd, is when we get up to about the 75 level. That means folks are a little too exuberant about things, but we can stay up here for long periods of time, so we don't immediately shift and go the other way. When we're going down and we get down to about the 25 level, that means folks are getting very pessimistic. And we can stay there for short periods of time, or we can stay there for longer periods of time. And we just look at setting things up in the opposite manner. It's not going to feel like the right thing to do, but it ends up being the right thing to do more often than not. But for right now, sentiment is remaining positive. Here is a daily chart. One thing to be aware of here. You see these dashed lines? These are called pivot points. And they're put on here automatically. They're pre-calculated. We know they're there. We already see the pivot points coming up here for July and even into August right now. And we did come down on Thursday, but this area held up as support, and we're still above this area for right now. So this is, for the time being, is positive. If we break below this, that could show some more significant signs of weakness. If we keep going up, we do have some overhead resistance, not only at this dash line, but at the pivot point going out for the rest of July. And the markets will often bump into this, especially the NASDAQ and NASDAQ 100, but the S&P will follow these as well. And this can often produce some either support if we're going down or resistance if we're going up. Then we're looking almost too good here. We're getting some extreme positive readings currently. This is called the boom indicator, and I developed this indicator decades ago, but I never gave it a name until just a couple of years ago when I was going to an online webinar, and somebody was describing the principle behind this indicator, and they said, you get too far away from the moving average, boom, and you go back. You get too far below it, boom, and you go back. And so I just started calling this the boom indicator. Well, what I've done on this chart is how far away are we from the 20 period, 50 period, and 200 period moving averages. And we can use this like an oscillator in the fact that we're getting kind of far away from the 20. We're getting kind of far away from the 50. We're improving, but we're not necessarily far away from the 200. So that's one positive thing in that we're going up, but it's also a warning sign, meaning that we might revert back to the mean, so to speak, here, because we're getting kind of far away from these moving averages. Another thing is that we're looking positive, maybe a little too positive. Now, this is my primary indicator. This is probably, if somebody said you could only use one indicator, which I never do, I use as many as I can. But if I could only use one, it would be the ADX, the average directional movement, because we get a lot of information from this indicator. Now, this is short term. And the black line, that's the actual ADX itself. And when it's going up, that means that the trend is getting stronger. I also put the moving average on here to give it some context of movement. And then do we know if it's a positive or negative trend? Well, if the green line's above the red line, that means it's positive. We're really going up. We're above 40. We're getting to a pretty high reading here. Doesn't necessarily mean we're going to reverse, but this is just an area that we want to be aware of. And even though we were up in Friday's session, the green line came down. It came down on Thursday, and it also came down on Friday. We want to see the green line going up to be more positive on things. So just a little bit of a warning sign. But for right now, there's positive things and there's negative things that you can take from this chart. Now, the ADX that I focus on the most is the intermediate term. And this is the real indicator. This is a little bit longer term, but it's also getting above this 40 level. It's still showing that we're in a trending condition. The green line is on top, but it is going down. Just a little bit of a concern there. Another thing that we follow very closely is the VIX. This, like the fear and greed index, the VIX also measures sentiment. When the VIX is low, that means there's really not much fear in the market. When the VIX is high, that means there's a lot of fear in the market. And we're coming down on a closing basis. That's the line chart. And we're below the declining moving averages. So fear has been dropping off. Then we look at a bar chart, which gives us the spread for the day, the open, high, low, close. And we closed kind of in the middle of the bar. And these moving averages are also coming down, just suggesting there's not a lot of fear in the market. Now, one other indicator that we can use in conjunction with the VIX is a VIX of the VIX. which sounds kind of strange, but this just measures how wild is the VIX right now. When this is going up, that means the VIX is getting kind of crazy. When this is coming down, that means the VIX is getting a little bit more tame. We're actually dropping off quite a bit here, but we closed near the high end of this bar. We did fall down a little bit in Friday's session, but we're above the moving averages. So we're seeing a little bit of increase in the VIX itself. Then this is put out by Tom Bowley, who's connected with stockcharts.com. He also has another site called earningsbeats.com. He did some research, and the numbers that you see here were actually from October of 2023, but the chart is up to date as of Friday. And this just says, okay, what happens when we get to different levels with the VIX? And he went back and actually did some research and pounded out some numbers and then annualized these. And when we get to a really low reading, below 13 for the VIX, and we closed at 12.46 on the weekly chart, so we're below 13. That's when we see the best annualized returns. That's when the market really shows some solid gains. There's this cliche in the stock market: when the VIX is low, it's time to go. Well, yeah, but you might want to hang around for a while because there still might be some gains that you want to get. And even when we're in really solid upward moves, the VIX can remain at low readings for quite a long time. And this is a weekly chart where I usually analyze things on a daily chart. Then if we get above 13, but we're still below 17, we see really positive results there, but they're quite a bit less. And then when we get above 17 up to 20, we are cut in half with our annualized returns, but they're still pretty solid. When we get above 20, that's when we start to see negative annualized returns. Right now, the VIX is really low, and that lends itself more to a positive climate. We are looking at the momentum of the VIX. Is it tending to go up or down? And that's measured by the MACD. We're still going up. We were trying to roll over a little bit here, but the VIX is actually going up just a little bit. There could be some hedging going on, and that's what this measures. When we're starting to really go down, that means that people are starting to hedge their S&P 500 positions with S&P 500 options, and that makes the VIX go up, okay? But that also bites into their returns. And so when the VIX is really going up by itself, they don't put on as much protection, and that's what makes the VIX go down. Well, we're having a tendency to still maintain positive momentum with the VIX currently. Then this is an area that a week ago, and even in the daily videos, I was bringing this up as a concern, but it, for right now, seems to be improving. This chart, and it's a long-term chart, it measures the spread between risky bonds and not as risky bonds. So when this is going down, that means there's not a lot of fear in the bond market. When this is really going up, and you can see this was the COVID crash, this was a great financial crisis. Other times when we've had difficult periods within the stock market, this really starts to go up. Well, overall, this has been going down, but lately we've been seeing it turn and start to go back up slightly. Now, remember this chart, because the next chart I show you after this is going to be inverted, and it's going to kind of play tricks with your mind here. What I did is on the top here, we have the S&P, and I wanted to have everything match up with that. So we have the S&P going up, just setting all-time highs this past week in the middle of the week. Then the chart that we just looked at, this is a shorter term version of that same chart, where when we're going down, that means the fear is going up between the risky and not as risky bonds. And I was noticing that we were starting to come down here, and that was causing a little warning sign. Well, now we're starting to go back up. So this is looking a little bit better. And then I inverted this to make it a little easier to match up with the S&P. And then also I inverted the VIX down below, which shows that there's just not a lot of fear in the market right now. There's another thing called the skew index. Now, when they calculate the VIX, they use at the money options. When they calculate the skew index, they calculate it using out of the money options, either above or below. When we get up into this red area, and we've been up here for a few days now, the market is expecting some kind of a big move. But we're not really sure. Is that going to be to the upside or the downside? Well, let's go back and see other times when this spiked and then just came down. Sometimes it marked a top, sometimes it marked a bottom, sometimes it marked a continuation. So we don't really know. We have to use other charts to give us some context. But we're up in that red area right now. So we just want to be aware of some kind of potential move, either up or down, that the market is expecting. Also, the active asset managers, they're getting positive. In fact, maybe a little too positive. And these folks are human beings and they have peer pressure and they have quarterly reports and they have clients they have to answer to. And if they can't even beat the S&P 500, they're not going to be an active asset manager for very long. And so they have a tendency to act on emotion just like we all do. And they were getting really extreme. Well, they've come down a little bit from that extreme reading a week ago, but they're still extreme right now. And they're really famous at buying tops. Now, these are professionals, folks, but they screw up too. So we use this as a contrarian indicator when it starts to get really extreme. Right now, we take it as positive. We just want to be aware of this. Now, we are showing some improvement when we look internally inside the S&P 500. This is measured by the advanced decline line based on price and volume. We were getting concerned here because we were going up with the S&P, but we were not surpassing this previous high based on price. We're just about clearing this previous high again, and that gives us more confidence. That means more stocks are participating in the upward move, where we were going up with the S&P, and it was only a few stocks that were driving things higher based on price, and this was really lagging behind, and that was a negative divergence. This may be getting taken care of now. We just have to see where it goes from here. We were looking better the whole time based on volume. Even as the S&P was going up, this volume was at least going sideways. It wasn't negatively diverging. And then it's actually been showing some more strength here. And this is times when the market can really be positive, when you see volume going up before you see price. And now, but it's not necessarily true all the time. There have been times when we've seen volume trying to lead price and it didn't lead to anything. Well, this time it seems to have led to something significant, at least through Friday's close. Then we also look internally at the new highs and the new lows. We had a down day on Thursday when the market should have gone up. We had an up day on Friday when the market should have gone down. How's that for stock market logic? We had CPI come out on Thursday that was friendly. It was weaker than expected. And it looked like, here we go. We're really going up. And the market just had a down day. Then we had PPI come out on Friday, and that was stronger than expected. And I'm like, okay, maybe the market's going to tank here. We ended up going up. Okay. That's why you cannot apply human logic to the stock market. That's why we look at charts. Well, as these things have been going on in both Thursday and Friday session, even though we had a down day on Thursday, we saw lots of improvement internally in the S&P and in the broad market itself. One of those was the new highs. You can see even in Thursday's session, we were down with the S&P, but we just really went up in Thursday's session, and we went even beyond that in Friday's session. And so this is showing some real improvement. Now, it's going to take a while here for the 5-day to start to turn back up, but our 10-day moving average is starting to go back up. So we are seeing some improvement here. Another internal measure as we look at the advanced decline ratio in the short term based on 19 periods, and then in the more intermediate term based on 39 periods, we were just dancing a little bit above, a little bit below zero. Well, then in Thursday and Friday session, we started to really go up, even though we were down on Thursday and up on Friday with the S&P. Now, the next three charts are what I call the smart money charts, because this not only measures what's happening, these indicators are based on volume. So this tells us what the institutions, the smart money is doing, because we want to be doing the same thing that they're doing. These charts are positive for right now, but they're flashing some warning signs to us. This first one is the accumulation distribution. Now, if you just look at the indicator, it's above the moving average and the moving average is going up. That's positive. But just like the moving averages to price, sometimes we get a little far away from this moving average, and that's what the boom indicator down here measures. And we're getting a little bit far away from this moving average, even though we're coming down slightly. So we might pull back a little bit here. Doesn't necessarily mean we're going to turn negative, but it may mean that we're getting a little too optimistic according to this chart. Now, the second smart money chart is called the Chaikin money flow. And this is positive, but you see how it's trailing off and how the moving average is going down? Okay, that's causing us a little bit of concern right now. That means the smart money isn't really coming in and doing a lot of buying in the S&P based on this indicator. We want to see this go back up and see the red line turn back up as well. Then we also have the Chaikin oscillator. which is still positive, but it's been declining, even though the S&P has been holding up quite well. Another warning sign. So when you take all of these three together, yeah, they're positive, but the context is we need to just be aware of this. And I go over these in every daily video. We are looking more positive here. When we break out the 19-day advanced decline ratio based on price, we were dancing around the zero line and we shot up. That's good. Now, this also takes volume into account, and that's been shooting up above zero as well. So we are seeing an improvement here. Now we have a few intraday charts to look at. The blue is growth and the red is value for the large caps. We have been seeing where the blue line's been above the red line, and that's when the S&P has been going up, even though only a few stocks were really participating. Well, we're seeing a real improvement here with value, and value can do well in a strong market. But where we really like to see growth is we want to see this blue line above the red line, meaning that growth is outperforming value. And they're more or less even right now. Then we also look at an intraday chart just of the S&P growth to value ratio. We had been going up since the latter part of June. We had some down times along the way. But when you look at this in the context, this was what was really helping to drive the S&P higher. We're trailing off a little bit right now. Now, it's still positive. It's still holding up. It's not necessarily falling apart, but we want to see this ratio eventually turn and go back up. Then we break it down in the small caps. Now, small caps, this is the small cap index. Now, this is SML. This is not the Russell 2000 small caps. This is the S&P 600 small cap index. And we were really screaming up here back in November into December. It's like this, okay, January effect, baby. And then we got into 2024 and boom, we just been going sideways. We came right back up, then went down, went up, came down. Are we finally breaking out to the upside? That's what I'm talking about with this climate change with the S&P. Think back, and I don't have a longer term chart here. You have to watch the daily video. So you have to take my word for it here. When we were really going up after the COVID crash in 2020 and into 2021, the small caps were leading things higher. We were in a zero interest rate environment, and the small caps were going up, and the mid caps and the large caps and the mega caps, everything was going up. And that was a really positive environment. We get into a higher interest rate environment where we've been for the last couple of years, and the small caps have really languished. Well, if we're getting to the point where they're cutting interest rates, because small cap companies are more susceptible to higher interest rates, and this could be suggesting that the small caps might get a fire underneath them. But be aware, we've seen this breakout potential before only to have it fall back. This would be the fourth time in 2024, you could go back into late 2023, that we tried to break out and we've been unsuccessful. Now, eventually, we probably will. But is this going to be the time when that actually happens? So that's looking at the index. When we look at the growth to value down below, we're not really seeing any real strength at this time. The mid caps. This was one of the stronger indexes through a lot of 2024. But as we've been going up here, looking pretty solid, then we hit this sideways trough, and we've actually been dropping lower. Now, we have not been able to get back with the mid caps to these previous highs yet. Can they continue to go up and show some improvement? In the meantime, the growth to value ratio down here is really not showing signs of an improvement along the way. In fact, with this ratio, we've seen a recent death cross. So I wouldn't get too excited about the small and mid caps until they prove themselves more. And I have some other charts later to show you of this. What I really focus on is S&P growth to value, because I do everything around the S&P 500. This is still holding up, even though it has been pulling back lately. But we finally broke out above these previous highs here. So for the time being, it's still looking okay, but we want to eventually see this ratio go back up. This is looking at a couple of ETFs, a growth ETF, and then taking a ratio with a value ETF. Yeah, we've come back down to the top end of the rainbow. But when you look at the larger context, growth is continuing to outperform value. Then we also keep an eye on discretionary, the thing that makes life fun. And you can see here, they're actually starting to break out a little bit. And this is things like Tesla and Amazon, where Tesla's really been a drag on the discretionary sector. And then staples. These are the things that you have to have, like toilet paper and toothpaste. Boring things. But when the market is more defensive, that's when the staples really do well. And then we measure the ratio between the two. We're seeing an improvement here, but we want to see this continue going forward to have more confidence that we're really breaking out and changing to a more positive climate as far as the discretionary to staples ratio is concerned. And we look at a number of different growth to value ratios. We're actually coming down now with the Qs to S&P back down to the moving average, but the moving average is still going up. Discretionary to the S&P showing a little bit of improvement, and now the moving average is starting to go up. We're coming back down to an advancing moving average with large cap growth compared to large cap value. So we are still holding up with the large caps, but we're not really seeing that follow through with the mid caps or the small caps, at least yet. So we're not seeing an awful lot of strength, at least on a continual basis yet. Then we look at the condition of the trend, and this is based on 20 periods, and it's a double and triple exponential moving average. That's what the green and the blue lines are here. We're above both of the lines, and the lines are going up. So in the short term, and I define the short term by the 20 period moving average. I know people use a 5 and an 8 and an 11.2 and a 13.6, whatever you want to use. I use a 20 period. That's what I go with. I think anything slower than this, it's a little too whipsaw-y. I know that's not a real word, but I just created it. This gives us more of a definition, in my opinion, and we're still looking solid in the short term. Now we look at the 50 period. That's more intermediate term. We're still above the red and blue line, and the red line's above the blue line, and everything is still going up. So this just suggests right now that the intermediate term trend is holding up. Then we look at a 20 period moving average, a simple and exponential, because I'm always asked, which one's better? The simple takes all 20 periods and divides by 20 and they're all treated the same. Where exponential, it weights it more towards current price. The takeaway from this is both lines are going up and prices above both of those lines. So the short-term trend continues to be positive. Then we look at a bunch of different moving averages going from 20 periods up to 200 periods. And we're above all the moving averages here. And all the lines are going up and everybody just looks happy together. Now we look at the momentum, and we were looking a little more negative. Now we're trying to shift back a little more positive, but then we could be shifting a little bit more negative. This takes a little more time to develop. When you look at all these different charts, the top two are short-term oscillators where we're flat with the slope. We're rolling over, a little bit of a warning sign, but we're also above this blue line. That means we're getting an extreme positive reading. So a little bit of a warning sign there. Then I have three intermediate term oscillators, a MACD, a PMO, and a PPO. Now the MACD, that's looking okay above its moving average. The PMO and the PPO also above its moving average. Then we have a couple of long-term oscillators. The TRIX, it's trying to get above its moving average, but the KST, another long-term oscillator, is pretty much right on top of its moving average. So we're seeing a bit of a mixed picture here. The S&P is going to either break to the upside or the downside. Now, right now, I would take this as positive, but you see how we're getting really extreme readings with some of these oscillators, but this can last in positive environments. Then we look at the Swenlin trading oscillator, and this to me is on the border between a primary indicator, the ones that I make my decisions around, and a secondary indicator, which I just use to confirm the primary indicators. This is right on the border. That's why when in the daily videos, I have it yellow instead of orange. Well, this was developed by Carl Swenlin, and we have a component to this based on price and volume. We're above zero in advancing, and so this is positive. Then we're looking at the moving average study with the S&P 500 index itself. This is just the price of the S&P, where we're getting kind of extreme with the 20 period moving average. We're going up with the 50, and 200 is also improving. When I did this video a week ago, we were a little nervous here because these moving averages were really lagging behind. Then we look at the rate of change going back 50 periods. That's more intermediate term. Doesn't mean we're necessarily going to stop here, but we are above this red line. So other times this can mark some point of exhaustion, but we could still go up from here as well. Then we go back long term. This is the rate of change going back 200 periods where we're getting up to this blue line. In the length of this chart going back to 2021, we haven't had this high of a reading before. So we may even be getting a little overextended on the long term, but for right now, it's still considered positive. This a week ago was negative. Now it's turning positive, and in fact, it looked and even looking extreme positive. This is more short to intermediate term. This is the S&P 500 McClellan oscillator. And we were getting nervous here because we were seeing the S&P going up and we were seeing lower readings here with the McClellan oscillator. That's a negative divergence. And we were actually negative a week ago. We were below zero. But you see how this is really going up and we're actually getting to an extreme positive reading now. Now, this indicator, when it's above zero, that affects the next chart, which is called the summation index. And when we're above zero with the McClellan oscillator, that makes the summation index go up based on price. Now, another thing is there's a completely different indicator down below, but this measures the volume of the summation index. And one nice thing about this chart, and if you were watching the daily videos, you saw this, we were starting to turn up with volume before we started to turn up with price. Now, we're still seeing a longer-term negative divergence here where the S&P is going up and we're not making those highs yet. And this is a primary indicator to me, but I'm not necessarily using this to get into any positions because when I really use this in as a single indicator to determine if I get into any positions is if we've been just screaming to the downside, we're bottoming and then starting to go back up. That's not what's been happening here. We've just seen this negatively diverge as the S&P's been going up. We really haven't seen a downward move, but this is improving and turning back and looking more positive. Then we look at the advanced decline line based on price on a cumulative basis for the S&P, and then volume also on a cumulative basis. We were seeing volume doing better before price was. We're finally starting to break out above this previous high based on price, and we're really breaking out nicely based on volume. Can that continue? The parabolic SAR, this is another primary indicator. When the dots are underneath, we are positive. Then this is another area that it's still producing a negative divergence where we were going up with the S&P and we're seeing lower readings with the bullish percent index, but this is starting to improve. It was already positive since it's above 50, but the fact that this is now starting to go up is really showing some improvement here. What this measures, this is not a moving average based type of indicator. This measures the point and figure buy or sell signals inside of the S&P. When this is going up, that means a lot of buy signals are being generated. So this is just showing some improvement for right now. Then we have the vortex, and this is a pretty easy indicator to interpret. Green line on top, positive, red line on top, negative. Well, we were going up nicely, but then we actually were going down on an update. When the S&P set an all-time high on Wednesday, this came down. And then when we had a down day on Thursday and an up day on Friday, this has been flat for 2 days. Now it's still positive because the green line's on top, but we want to see this green line continue to go up to remain positive with this indicator. And this is also a primary indicator. Then we look internally. On top here, this is just a raw score of the new highs minus the new lows for the S&P. When we're above zero, that means there's more new highs than new lows. Then there's a red line that goes through here that's almost impossible to see, so I break it out down below. Well, then I break it out into its own chart here on the next chart that I'm showing you, where we had been declining, and that was causing some concern and a negative divergence. We're starting to turn back up now. We want to see this continue to go up to remain positive. Then we look at those stocks inside of the S&P and then various moving averages. The first chart here is those stocks in the S&P that are above their 20-period moving average. We were seeing negative divergences here as the S&P was going up. Now we just saw this really nice upthrust. We're getting above 80 right now. So this is showing a lot of improvement. In fact, we're getting a little extreme positive. Then based on that is this study where last April, when we had a bit of a downturn with the S&P, we came down and we had an extreme negative reading. And then not too long after that, we saw an upthrust. And then look at what the index has been doing after that. Well, we're kind of comparing this, and I don't like these people that say, well, if you look at now and compare it to 1963, and man, look at what happened then, and the same thing's going to happen now. Okay, I look at those things. They're interesting. We use them as guides, but I don't make decisions around them. But we are kind of looking back to a similar type of situation that happened in March of 2023, where we went negative and then we thrust up, and then you can see what the index did after that. We're wondering if that same kind of thing is going to keep on developing right now. And it took a little while. We had the upthrust, and then we dangled around here looking, oh no, what's going to go on here? And then we finally saw an upthrust again. That could be what we're seeing right now. Is a very similar situation. Then we look at those stocks that are above their 50-day moving average, and this had actually been negative. When it's below 50, then it is negative. We were able to show an improvement. Now, longer term, we're still seeing a negative divergence here, but recently, this is actually showing a little bit more strength. So if this can continue to go up, that'll be more positive. Then we look at those stocks above their 100-day moving average, and it dropped below 50. Now it's coming back up and showing an improvement. And those stocks above their 200-day moving average also showing an improvement here. So this is more internally what's happening and shifting to what potentially could be a more positive climate for the S&P. Then we look at the S&P, which is the bar chart, and the NYSE advanced decline line. When this is going down, even though they're on different scales, when this is down below the bar chart, that means the NYSE is underperforming on an advanced decline basis. This really shooting back up is positive. It would be even more positive if it could actually break above the S&P bar chart itself. Then this is a longer term indicator that is showing an improvement at this point. This is a 10-day average of the S&P 500 highs minus the lows. We were camped up here above this, was that 80 or 90 level, this green line. It's really hard for me to see these numbers on here. We were up here for a long time, and then we dropped down and then have been starting to come back. We weren't really showing a lot of improvement here because there weren't a lot of stocks that were really driving the S&P up. We are seeing an improvement, but we're not above this green line at least yet. But this is still looking better. Then this is a weekly chart of the S&P, and we're still above for the fourth week now, this R2 level. This is a pivot point. The cool thing about pivot points is these are on the chart before we even get there based on time or price. Are these pivot points important? Well, tell 2020. Okay, let me try that again. 2021 that. We were just screaming up out of the COVID crash. We hit one of these pivot points. This was the beginning of 2022. Then we started to bounce back up. And then a year ago, we came up and we hit one of these pivot points and we ended up having a 10% decline. We were able to get back above this R1 level. We even fell below it for a little while last spring. Now we've been breaking above this. And for 4 weeks now, we've been above this level. So this is looking more positive longer term. Then we look at a ratio between the S&P and the utilities. When this is going up, that means the S&P is outperforming. When this is going down, that means utilities are outperforming. This is still positive, even though we've been pulling back over the last couple of sessions. We want to continue to see this ratio to go up to be more positive. And then we also look at a ratio between staples, remember toilet paper, toothpaste, compared to the S&P. When this ratio is going down, that is positive for the S&P. And then this is a newer chart here because this hadn't really been doing much of anything. This is the 2-year treasury yield. And sometimes when it spikes and starts to come down, that can give short to intermediate term support to the S&P. And we're wondering if that's what's happening right now. Then we look at the 5-period moving average of highs minus the lows across the Amex, NASDAQ, and NYSE. We had fallen below zero, but now we're starting to come back and climb above zero. So this is looking better for the broad market. Then we look at the NYSE bullish percent index, where the S&P bullish percent index is looking better. We're also seeing an improvement here. So we're looking better with the S&P index. This is more of a broad market measure that's also showing an improvement. We're also seeing some improvement here with the advanced decline line studies. With the NYSE common stock, we're coming back above the moving average. The S&P, which was on the moving average, is breaking above, seeing an improvement with the mid caps and the small caps. Can this continue is the question. Then looking at the cumulative advanced decline line for the NYSE, really breaking out, looking solid here. The regular NYSE advanced decline line is also breaking out. And then there's another NYSE advanced decline line, which is calculated slightly differently. This is also breaking out above its moving average. So this is suggesting more broad market strength. Then we look at the common stock for the advanced decline line on the NYSE based on price. And see how we're already breaking out here based on volume? We haven't broken out above this previous high based on price. But this could be more positive if we're actually seeing volume going before price here. Then we look at the staples to tech ratio. When this is going down, that means staples are underperforming tech. In a more positive environment, we want to see this ratio continue to fall. Then here's the NYSE McClellan oscillator, which had also dropped below zero, showing a lot of improvement, suggesting more broad market improvement across the board there too. Then when that's above zero, the NYSE summation index based on price is turning up, and we're also turning up again based on volume. Keep in mind, we still have these negative divergences as the S&P has been going up. We've been making a series of lower highs here, but if this can continue to go up and surpass some of these previous highs, both based on price and volume, that would negate those negative divergences. Then we look at large cap growth. It's coming down off of its highs, but it did set an all-time high earlier in the week. And we're also doing a ratio between the large caps and the small caps. Now this is coming down here, and it's off of its highs, but this could actually end up being positive if the small caps are really kicking into gear. The NASDAQ is also maintaining its pivot point support for right now above this R1 level. That's still holding up. We're also holding up above this R1 level for the time being. We pretty much closed right on this pivot point on Friday. Then we look at the NASDAQ 100 bullish percent index above 50 and going up, not really breaking out, but it's still looking positive nonetheless. Then we do the S&P 500, which is a weighted index, and we compare that with the equal weight index. And this had been really underperforming. And all the doomsdayers and perma bears are going, oh, look at this negative divergence. Only a few stocks driving the market higher. All the rest of the stocks are down on this. Well, now we're starting to see more of an improvement. Can this continue? And then here's another look at that same ratio. When this is really going up, that means the really big companies are really holding up the market. And we had got to a really high reading up here, higher than what we've seen over the last number of years. This coming down is not necessarily negative. That just means that more stocks are participating in the upward move. When this ratio is going down while the S&P is going up, that's a good thing. Then we look at the Wilshire. This is a daily chart, another broad market measure. It closed in about the middle of its bar on Friday, but this also is coming off of setting all-time highs. The total U.S. stock ETF also down a little bit, but setting recent all-time highs. The FANG index off of its highs that were set earlier in the week, so we're seeing a little bit of profit taking there, but still looking positive. The semiconductors, which are a huge part of the tech sector, we're showing an improvement here, even though we're off of the highs. And then you look at the tech sector coming off of its highs, but still looking pretty solid. And this is what's helping stocks go up right now is the 10-year yield declining. We want to see this continue to fall. And then we look at some ratios between the 10 sector and tech sector and 3 to 7 year bonds, where we're still holding up fairly well above the rainbow. Also, the market is still anticipating a soft landing, which means we're not going to go into a recession, according to the market. Now, if this changes and this thing just totally goes in the toilet, yeah, then we might end up going into a recession. And this is also a very similar chart. When this is going down, that means the bonds are underperforming stocks, and that's more positive for stocks. And here's a weekly chart of the NASDAQ 100. Going back to a trend line set in 2009, and we're still well above that trend line. This is the ratio that I actually got from a perma bear. And I haven't seen any videos by this person because they thought we were going to come up to this red line again and then everything was going to completely fall apart. Well, we've been going up, but they haven't really said anything since then to try to explain why the market isn't falling apart. But this is a ratio between the NASDAQ 100 and the Dow. And as this keeps going up, that is more positive for the market. And we look at the Qs to the small caps. Now, this could actually start to change. If the small caps, which is the IWM, that's the ETF for the Russell 2000 small caps, and the QQQs, which is the NASDAQ 100, that's when the Qs have really been driving the market higher. We are coming down with this ratio. And if the small caps are going to take a leadership role because interest rates are falling, then we're going to see this ratio fall. Now, if that does start to happen, which has not started to happen yet, we haven't even come down to this blue line yet, but we'll just be watching that with other charts. The problem that I have with the perma bears is they use one chart like this and they make all their decisions based on that. They don't use any other context. No wonder they're wrong 70% of the time. Okay, another one, semiconductors to the Dow, also holding up as the semiconductors are outperforming. Again, the perma bears were saying, we're going to get back up to this and then just fall apart. This was supposed to be the holy grail of what was going to happen. Well, it's playing out opposite to what they thought. Then we look at another ratio between the Qs and 3 to 7 year bonds. Even though we're pulling back, we're still above the rainbow and going up pretty solidly. We look at the S&P 1500 and compare it to short-term bonds, also showing how stocks are outperforming. Another broad market measure with longer-term bonds, also showing how stocks are doing quite well. Now we look at the negative side. This is just looking at the chart with the QQQs. This is a weekly chart, which is the Qs or the NASDAQ 100. To open, go up, down, and then close right about at the same point. That's a little bit of a warning sign to us. That's doji in candlestick lingo. And sometimes this can mark a reversal. Now, I also pointed this out a couple of weeks ago. I was worried about that. Didn't lead to anything. So it doesn't necessarily mean things are going to switch. We just want to be aware of this as it's happening. Then this is another concern. The momentum for the NASDAQ 100, as measured by the PPO, is starting to drop off and in danger of dropping below the moving average, which could turn the momentum over negative. Another thing to be aware of there. Here are the small caps. Now, I have them on the negative side because it's negative until proven otherwise. We've been teased in this area. Now, personally, I don't do small caps. I don't do the index, but I keep an eye on them. And I know a lot of people that watch these videos do small caps. So I'm kind of pulling for you here. So when I say we, it's just more of this generic form here. Are we really breaking out and setting some kind of a breakout point here? When we look at this, yeah, we're seeing some improvements, but we need to see more evidence first. When we do a ratio between the small caps and the S&P 500, yeah, they're bouncing back up on a ratio basis, but they're still underperforming. Personally, to turn more positive on the small caps, we want to see this continue to go up, break above both of these moving averages, and eventually see the moving averages cross back over positive. That's what they did back in 2020 and 2021. That was a really solid environment. We want to see something like that happen. Are we building something like that over here now? But we've seen these false breakouts before. So we need to see more follow through with this. The mid caps also, this was one of the stronger areas. We go back in here to January and then March and then into April. This was one of the strongest indexes when we were going up. And then we hit June and they just kind of blah, 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 just drifting off lower. Now, are they finally breaking out? They still haven't been able to get above these previous highs yet. So, but we'll be watching this and I'll be updating this in the daily videos. Then this is another negative divergence that we're seeing. This is the equal weight S&P on top. We have not set a new all-time high yet. We're improving, looking a lot better here, but we have not surpassed this previous high. If we can set a new high, that would be more positive. Where we are setting new highs here with the QQQ equal weight. So the bottom part of this chart's positive, but it's not being confirmed by the top part of this chart. We want to see them both confirm each other. Then we look at 1 to 3 month T-bills, which is cash, and compare them to 3 to 7 year bonds. We want this to continue to decline, but the reason why it's negative is we're still seeing an uptrend with this ratio. We want this to really fall and eventually see the blue line cross below the red line. And the same thing is true here with the 1 to 3 year bonds and 3 to 7 year bonds. This is falling. It's looking better, but we want to see this go and all the lines in the rainbow start to turn down as well. We want to see that same thing here with tips to 7 to 10 year treasury bonds. We want this to go down and eventually see a death cross with this ratio. Then this is looking a lot better, but still we're kind of apprehensive here. This is home construction to 3 to 7 year bonds. Now, home construction is very interest rate sensitive. We were doing well in late 2023 and through a lot of 2024 above the rainbow. And then we started to kind of drift off here. We kind of went to Oz there in the rainbow for a while. Well, you notice what happened back in October? We came down to the 250 period moving average and then bounced up off of that. And we saw a nice solid up move for everything going into the end of 2023. Well, we came down to the 250 period moving average and we're bouncing up off of that. Is that same kind of thing going to happen this time? We don't know. We can just look at what we see right now and go, okay, maybe something like that will happen. Then we look at the Eurozone. Now, we're having political problems in the US. And as I record this, it's about 12 hours after the attempted assassination of Donald Trump. We don't know what's going to happen. There's all this uncertainty about what's going to happen on the Democratic side. But Europe has had their own problems recently, too, with elections. A week ago, they had an election in the UK, which was a real shift in their government there. They're still in the process of having some elections in France, and that's all the Eurozone stuff. Now, the UK is not part of the Eurozone anymore. They got out of the EU, but they're still geographically close. And so we've been seeing the Eurozone really trailing off when compared to American 3 to 7 year bonds. They've been showing some improvement. We are still negative here, but we want to see this continue to go up and get back above the rainbow, because sometimes what happens in Europe precedes what happens in the US. And when the US markets and American markets are more in conjunction and moving in tandem with each other, that tends to be more positive for both markets. Then we're looking at regional banks. Now, they had a lot of these regional banks. This includes Silicon Valley Bank, Republic Bank, and then a few months ago, near the beginning of the year, New York Community Bank. A lot of these banks are having some problems, and there still may be more problems yet to come, but they haven't developed as of yet. And you can watch all these YouTube videos and all these self-diagnosed geniuses out there who have all these reasons why everything's going to fall apart. We follow the charts and then actually go with what's really developing. When we saw this really coming down, when we do a ratio between the regional banks and the financial sector, this is when Silicon Valley Bank and Republic Bank happened. And then it looked like we were finally starting to improve. And then New York Community Bank came out. And that's when we fell down here. We're seeing some improvement, but we haven't shifted over positive, and we're still negative as far as this ratio. It would be more to the benefit of the markets to have these regional bankings doing well, because they need a lower interest rate environment, because a lot of the commercial real estate loans are generated through these smaller banks. And now there's two sides to that argument too. On one side, are these commercial loans, are they in trouble? Well, part of the side says, no, this is a good old boys club. They're just going to shift things back and forth in such a way so that nobody will get hurt. On the other hand, there are people saying, yeah, I mean, we've got a high vacancy rate. Since the COVID lockdowns, a lot more people are working from home, and we're just not making as much money in a rising interest rate environment. We're really in trouble right now. So we don't really know what the answer is at this point. That's what I do with things. I look at the positive and the negative, and then we just see it all play out instead of reaching these conclusions and reaching these forecasts, because it's like predicting the weather 6 months from now. Okay, then we're also looking at a ratio between risky bonds, which is junk bonds, and conservative bonds. Now, I could have put this on the positive side because there's a positive aspect and a negative aspect to this chart. You see how we're coming down into the rainbow where we had been holding up as the market was really bouncing up? That's the positive side, is that we were going up. Now it's turning a little bit more negative as we're coming down. The positive side of this chart is riskier bonds. That's junk bonds. And if this is going down, that might mean that people are getting out of the riskier bonds and getting into the more conservative bonds, because interest rates have topped out. And now they don't want to take on that additional risk of junk bonds, and they're going to get into government bonds because interest rates are going to end up falling. And that might be why we're seeing this coming down. So there's both a positive side and a negative side to this particular chart. Then we look at the staple sector. This is defensive. When this is going up and looking at it by itself, that causes us a little bit of concern, because this is what happened right at the end of 2021, and it held up a lot better in 2022. And look at this solid uptrend that it's been in. But when we compare it to the S&P 500, it is really underperforming. So why is this on the negative side? Because of this chart right here, because we're seeing a solid uptrend. But on a ratio basis, we're actually more on the positive side with this ratio. Then utilities, another defensive area. Now, there's a couple explanations here. Could it be because of AI and because of all this crypto mining and because of this green new stuff that's supposed to happen? Everything's going to be generated around electricity, but nobody's really making a lot of electricity right now because the old ways are being outlawed and deemed politically incorrect. But a lot of electricity is going to be needed. And so that's really pushing the price up right now. Well, that's also what happened in 2021. Look how the utilities did much better in 2021 and actually were going up in 2022 as the market was going down. So there's a positive side that maybe there's more of a need for electricity and that's why it's going up, or that the market is getting more defensive, and that would be more negative. So we want to weigh both sides. But when we look at this compared to the S&P, it is underperforming. Now, there was enough of an upward thrust as utilities were going up to generate a golden cross. But right after we did that, we went down below these moving averages. And now even that's starting to show some more weakness. And we look at the dollar, it has seen a little weakness this past week. And even though it's in an uptrend on the daily chart and the weekly chart's in an uptrend as well, pulling back with the dollar is more positive for stocks. Then we have this crazy thing called the Hindenburg almond. And if you don't know what that is, oh, the humanity, that's a Hindenburg. Well, there's also a Titanic signal that I sometimes talk about in the daily videos. But if pause this and read through this, because everything that's said on this slide is shown right here in this chart. This is put out by stockcharts.com. And there are 3 components that are used to develop this thing called the Hindenburg almond. And the perma bears love this thing, and they're just salivating right now because they're so sure the end of the stock market as we know it is very near. They've also been saying that for 20 years as the market's been going up. Now, what happened back on July 9th, this past week? We saw a spike up. All right, that's step number 1. And what they do at stockcharts.com is they take the 3 components that make up a Hindenburg almond and put them together in this one indicator here. What we're waiting for now is between July 9th, which now we're after that, and we have up until August 2nd to see a second spike here. That would be a confirmed Hindenburg almond. For those of you that are perma bears, for those of you that listen to perma bears, I've actually heard a couple of perma bears say, we have a confirmed Hindenburg almond. No, we don't. This is not confirmed yet according to the rules. Now, these people are always predicting the end of the world. And I like to make fun of them because they're right off the bat wrong 70% of the time because the market goes up 70% of the time. Wait for this. Now, we do get a little bit of a delay here where this is not going to be updated until after Monday's market session. So there's a business day delay in this chart actually being updated. But if we see a second spike up between now and August 2nd, look at what happened other times before. This was before the COVID crash. This was at the end of 2021. I used to throw this indicator out the window because it was a perma bear that I learned about this from. And since they're always wrong, I threw this whole idea out the window. After studying this chart, I went, hey, maybe there is something to this after all. We can ignore what they're saying. We can just look at the chart ourselves. And then if we do see another confirmation, we want to pay attention to that. But we haven't seen it yet. Now, we have seen confirmations here with the NASDAQ Hindenburg almond. So look at all these confirmations up here. But look at what the NASDAQ did after that. It just kept screaming to the upside anyway. All right, so thank you. I really hope you found this helpful. I hope you have a very good weekend and a great week. Please feel free to check out the daily videos, check out the program, see if it's of any interest to you, and I will talk to you in the next video.